I'm Phil Rosen. I'm the Chief Market Strategist for ProCap Financial. You're watching Taking Stock.
Time for everyone's favorite part of the day. 2 minutes to go here until the closing bell on the trading floor of the New York Stock Exchange. Welcome to Taking Stock. I'm JD. That's Peter Tuchman.
Boom.
So volume 500 million as we enter the closing
Which is
auction.
good. That's
Pretty
good.
flat across the board. What'd you see in today's tape? And top of mind for you today?
You know what? We're sort of still in that. We're waiting, obviously, on Google earnings, right, coming out after the close. So there's a little anticipation there. I think the market, it's just kind of churning. Right, we're not really clear about what's going on. There's stuff out of the administration is sort of keeping people a little bit aside, a little anxiety in the market. We're not trading off oil right now. You know, there's a lot of rotation going on because we're seeing big order flow coming in and out, and it's kind of flipping both ways. So we saw, for the most part, it was $1 billion to sell all afternoon, and the market finally tried to break. If you look at the way the chart was, you know, we were trading flat around even money for a while, and then it's finally broke through. So you know what, the market's just sort of fighting the tape a little bit. Nothing major is happening. We're kind of in the corridor, you know, between waiting on the next level set of earnings that, as we know, one stock can really make or take the market.
Absolutely.
So we'll see how the Google story unfolds. A lot left to see.
That's a big one. We'll see the latest on data center, AI trade, Alphabet, and Tesla after the bell. Peter Tuchman, thank you for being here to kick things off as always. The team from PagerDuty, ticker symbol PD, here at the NYSE, set to ring the closing bell. More Taking Stock after this. I like when we get the bell with some authority. Your final tail of the tape on this Wednesday afternoon down here at the one and only big board. The S&P 500 down fractionally. The Dow down very fractionally, 0.01% as a matter of fact. The New York Stock Exchange Composite Index up about 0.1%, and the small caps, as to be expected, the Russell 2000, the hardest hit of the major market indexes. Utilities, energy, materials, the best sectors in the S&P. We do have some laggards, though, a bit of selling pressure in consumer discretionary, technology, and healthcare stocks. Let's bring in our first guest, Jacob Sonnenschein, as markets reporter here at Barron's. My man, welcome back to the show.
Thanks for having me.
Let me get your take first and foremost. The FOMC meeting next week.
Sure.
This will be Kevin Warsh's second meeting as Fed chairman. What are your expectations for how hawkish or non-hawkish this Fed looks to be the second half of the year?
I think first thing you got to remember, it's not going to be very easy for Chairman Warsh to be much more hawkish than he was when he first spoke in front of the media and said that inflation is essentially the priority. So I don't know if he's going to get more hawkish than that, but I think you have to remember the market is expecting something in the neighborhood of one hike this year. I'm expecting to continue to hold this microphone, but I also think that beyond that hike, I don't know that he's going to start jawboning more hikes than one because oil is volatile, but he's going to give you some chatter about a hike.
I'll hold this. We're going to do this because I don't know if this active microphone is working, so I'm going to pick this up. This is the beauty of live TV, and I'll just chat with you like this. Your expectations with regards to interest rate policy more broadly and the approach of this Fed between now and the end of the year?
Yeah, between now and the end of the year, Warsh is he's not going to sound dovish. I don't know that he can sound more hawkish than he did about a month ago because he said inflation is a priority, but he doesn't want the market, he doesn't want rates to come down so much until oil resolves itself. Oil's still up a lot, and we know what his priorities are in terms of inflation.
How are you? Give me 1 second. I'm going to do this my body while you and I do this live. Talk to me about big tech earnings after the bell today. We just heard from Peter Tuchman, the Einstein of Wall Street. We'll hear from Alphabet. We'll hear from Tesla. It's really the first of the big mega caps. We know how closely the market continues to pay attention, especially when these handful of very consolidated names in the S&P give us a sense of what's under the hood.
Yeah, I mean, I think the thing that chip investors are looking for is CapEx as usual. You know, Google just reported, I got to go home and read that stuff.
Yeah.
But in terms of Meta, which is also going to be this month, Meta has an opportunity in front of it. We know that the CapEx growth in terms of the guidance is huge, and that has weighed on the stock and has weighed on the valuation. There's concerns near term about return on invested capital, but if Meta can come in and say, we have excess compute that and give a little more direction on who and how and the scale at which they're going to sell that, they might even have a little more wiggle room to increase CapEx. I hope they don't, but they might have some wiggle room, and if they can increase that return on investment story with the cloud compute situation at a 19 times PE multiple, they could push their stock up.
Give me one element of these markets right now that you think we would all benefit from paying a little closer attention to, and I'm going to hand you that as you give this next answer.
Really boring dividend yielders. You have a bunch of 5% dividend yielders that I've found. There's some large cap names like Clorox, but there's also some REIT names, real estate investment trusts, companies that are growing their dividends every year and at least the last 10 years with pretty good balance sheets. Sometimes REITs have some weird wonky balance sheets with a lot of debt, but you can believe in that. So look at those types of areas. The reason is because the 10-year yield at 4.6%, I think that's heading lower because the oil situation, again, it's volatile, but I think we're peaked out at 4.6%. We've already gotten a big move, and it's very much ahead of inflation expectations. So if the 10-year yield comes down, look at some of these dividend yielders that are above 5% that reliably grow their dividend payment.
Before I let you go, and I'll give you one last question here. I know you like the chart of financials, perhaps poised for a breakout. What more is on your radar, knowing we got the big banks behind us, a few more key names like Blackstone and others still set to report?
Yeah, I keep looking at the reports. Blackstone, you mentioned, will report soon. Regionals over investment banks. Investment banks have absolutely exploded. They're starting to trade like tech stocks because of their IPO businesses. They're trading at high multiples as well. I would say, in terms of putting new money to work, I'd stay away from investment banks. Go to regional banks. The economy's strong. Regional banks in terms of lending will benefit, but all banks, including regionals, including some CEOs that I've spoken to of super regionals, they're investing in AI to the point that you can see with the naked eye margin expansion, you can see better profitability, and you can see maybe even double-digit earnings growth for a group of regionals that is far cheaper than your group of investment banks.
My man, thank you for being here. Total pro handling the mics, by the way. Really grateful for that. I promise I will never ask you to do that again. We'll talk to you again soon. Here are a few of the top calls here on Wall Street that moved the tape this morning. Truist upgrading CoreWeave to buy from hold. They call the risk-reward setup compelling. CoreWeave shares up 13% on the year. Next up, Guggenheim reiterating Disney. Yes, the House of Mouse as a buy. Shares down 15% year to date, have been trading below the 50-day moving average since June 24th. Finally, Wells Fargo reiterating SanDisk as equal weight, lifting the price target to, and this is true, $16.20. For a stock that came into 2026 trading at $244 a share. It's up more than 500%. Wells Fargo expecting the overall demand trends to continue the rest of this year and into 2027. Todd, how about Dell? That's not a typo. That's a Dell shares up 9.3%, one of the best performers in the S&P 500 today. Getting a boost after Supermicro disclosed a bullish raise in gross margin that helped to lift Dell shares today in sympathy. Shares of Dell gapping up back on May 29th, and you got to call it what it is. They've reconsolidated in a higher range ever since. Buyers refusing to let it fall down. Shares up 244% year to date. In part one of this edition of NYC Innovates, Cheddar's very own Chris Castellino explores the history of NYC's Silicon Alley with one and only Einstein of Wall Street, Mr. Peter Tuchman. Take a look.
In the mid-1990s, a new industry started forming in the shadow of the Flatiron District. At the intersection of Broadway, 5th Avenue, and 23rd Street, a hub for internet startups and digital media companies started to take shape. The press even gave it a name:
New York's so-called Silicon Alley.
This year, that identity turns 30, and the next chapter is already being written. Anthropic, the AI company behind the Claude chatbot, announced a 16-story foothold in Hudson Square. So in this episode of NYC Innovates, we're exploring the evolution of New York's Silicon Alley, from the early dot-com boom to the city's deep tech future. We'll meet one of Manhattan's fastest growing startups.
We use hardware and software to make the entire caregiving journey better for both parties.
Dive into what's next for big tech.
We believe that artificial intelligence, especially agentic AI, is the biggest shift in technology since the internet.
And take a trip to the floor of the New York Stock Exchange, where the markets have been changing right along with it.
This is not your grandfather's stock market that we're in today.
Stay with us. To understand where New York's tech story is headed, you have to go where finance and technology converge. the floor of the New York Stock Exchange. Peter Tuchman has been working as a stock trader for over 40 years, surviving Black Monday in '87, the dot-com crash, the 2008 financial crisis, and the COVID-19 pandemic.
When I walked in here on March 28th, 1985, I had a summer job as a teletype, and everything was being done manually and on paper.
A decade later, downtown Manhattan was in the middle of a very different kind of boom. And from his post on the floor, Tuchman had a front row seat to how Wall Street was pricing it. Most of the era's marquee names, DoubleClick, EarthWeb, and theglobe.com were soaring.
A lot of these young tech companies had huge revenue, but they did not have any earnings. Our lifeblood here on the NYSE are earnings, right? That's how we make our decision fundamentally when trading and investing in companies. And so many of those companies, it was decades before they actually made money. So I would imagine around the time of 2000, when the bubble burst, we kind of got a sense and realized that this was all smoke and mirrors. Obviously, it wasn't, because once we came off that pedestal, and we realized that companies don't necessarily need earnings right out of the gate to become a viable company, then we realized things were going to change. And then what was a bubble was no longer a bubble, and they became some of the greatest stocks of all time.
The catastrophic market crash Tuchman just described didn't just cost investors money. It nearly cost New York its claim to being a tech city at all. Through June 1999 and May 2000, the Federal Reserve raised interest rates 6 separate times, making it more expensive to borrow and less attractive to chase speculative growth stocks. On March 10, 2000, the Nasdaq peaked at just over 5,000 points, its highest level ever recorded at the time, and marking the peak of the dot-com bubble. In addition, a widely read Barron's story titled Burning Up warned that dozens of internet companies were burning through cash faster than they could raise it, and might not survive the year. Investors believed it. Over the next 2.5 years, the Nasdaq lost nearly 80% of its value and took most of Silicon Alley's biggest players down with it. When the bubble burst, Silicon Alley didn't just slow down. By most accounts, the scene essentially vaporized. Without a top-tier engineering university, or a heavyweight tech giant the way the Bay Area had HP or Oracle, it looked to a lot of people like New York simply wasn't built to be a tech hub. Eventually, the rebuild started, and fittingly, in New York's oldest industry, media. By 2004, tech blogs like Gizmodo and Engadget launched out of the city, riding the collapse of old publishing models. By the mid-2000s, that had grown into a massive wave of New York-born media and advertising tech companies. BuzzFeed, Vice, AppNexus, and Outbrain, built by a generation of founders who'd watched the first Silicon Alley collapse and built leaner the second time around. Through streamlined CMS systems, inexpensive agile content creators, and a free distribution model outsourced to social media.
Welcome back to this Wednesday afternoon edition of Taking Stock, live from the trading floor of the New York Stock Exchange. David Arana joins us now. He is the founder and CEO of Konfio. And I'm really grateful for your time for a really important conversation. Thanks for being here.
Oh, thank you for the invitation, JD.
Talk to me first and foremost, what is the banking gap that Konfio is addressing, specifically in the country of Mexico?
So Mexico has a very vibrant SME market, and it's the largest unmet financing opportunity after India. So it's a very large opportunity, and historically, if you look at the credit as a percentage of GDP, Mexico has less than half of the penetration that other neighboring countries have in Latin America, like Brazil, Colombia, Chile, Peru. So there's a lot of work to be done, and SMEs are what fuels the growth in Mexico and other countries.
And I know that there's been evolution to Konfio itself. You're no longer just an online lender. What makes Konfio so unique as you continue to expand what constitutes your overall financial platform?
Yeah, so we consider ourselves a one-stop shop for SMEs. We started out as a credit-first platform and then evolved to offer corporate cards, payment products, and we're in the process of obtaining a bank charter pending regulatory approval. And with what we've built now, in number of borrowers, we represent the third largest player in the country. after two of the largest systemic banks.
Talk to me a bit more about that banking charter or a banking license. What does that actually mean in practice for you and the firm? And what do you most hope that could unlock for your work at Confio?
So we think it'll unlock three things. One is a higher amount of trust with our customers, which, by the way, that's the name that we carry in Spanish, Confio. The second thing we'll unlock is more financial products, which will allow us to have a much stronger relationship with our customers. We already do, because for more than 80%, we were their first business loan ever, historically. And the third thing is also a stronger platform which will allow us to accelerate and expand with larger margins.
I mean, to me, it really sounds like a story about economic development. So why is it so important to empower these small and medium-sized businesses, these enterprises, in a country like Mexico, for any of our viewers here in the US who might be a bit unfamiliar with the dynamic?
So SMEs in Mexico represent half of the GDP growth, and they employ 74% of the formal workforce. So it is really what's going to drive growth in Mexico, in the region, and that's great news also in the US, because we're the strongest trade partners the US has. So it's good news for everyone.
And David, before I let you go, where do you most hope, or where do you most expect Confio can go from here?
I think we're still at the first kilometer of the marathon. We're just getting started. Sky's the limit, and our ambition is to be the go-to player for anything SME related in Mexico and beyond.
David Arana is the founder and CEO of Confio. Really grateful for your time today. Thanks a lot for stopping by the show.
Thank you, JD.
All right, we'll do it again soon. Folks, don't go away. A lot more Taking Stock coming up live from the trading floor right after this. Welcome back to the show. You're watching Taking Stock live from the trading floor of the one and only New York Stock Exchange. Our next guest joining us now, Jennifer Tejada is Executive Chair, John DeLullo, CEO of PagerDuty, respectively. It's great to have both of you. Thank you for taking the time.
Thank you, JD.
John, I'll start with you. Congratulations on your new role. As you ring the closing bell here at the New York Stock Exchange, what is your vision for PagerDuty's next chapter?
I think PagerDuty's next chapter is going to align with all of the great things that are happening in the world right now. The world's creating more software than it ever has before. That software continues to be fragile, continues to break in different ways, and we're there to help the most important companies in the world to be more and more resilient and to be able to keep their operations running 24/7, 365 days a year.
And Jennifer, I want your take, because I know it's not the first time you've been down here to the New York Stock Exchange. You led the company during the 2019 IPO. Now you're back for a new chapter. What does that moment mean to you then and now?
Well, it's a thrill to be back on the floor and back on the podium. The New York Stock Exchange has been such a tremendous partner to PagerDuty. It's been a wonderful 10-year run, running a business that really takes the care of our customers and their need to deliver for their brands and puts it first. And in 10 years we 10x the business, but nothing is more exciting for me than seeing a wonderful new leader come in and prepare the company for what I think is going to be its best days ahead.
And let me stay with you for the next one. After leading the company here for nearly a decade, why is the right time to sort of pass the baton and any of the other core values for PagerDuty that have stood the test of time over this last decade or so?
Well, our number one value is champion the customer, and it's all about building trust. And in the effort to do that, we've invested for many, many years, since the founding of the business in 2009, to build the most resilient enterprise scaled, secure platform for operations. And now with AI, we're able to do more, automate more, and enable our customers to do what they're great at, and that's deliver a wonderful brand experience. As we look forward, I'm really excited about the ability for us to take the proprietary data platform we have for John to lead the business in its next phase of growth, really growing into not only enterprise, but native AI companies, and just a tremendous opportunity, and again, an absolute thrill to be here at New York Stock Exchange.
All right, so John or JD, let's kick it back over to you. I want to get into some of the technicals here
Okay.
and help our audience better understand some of your business. What is actually an SRE agent for people who are unfamiliar? I know you have a new AI-powered one. What are you most hoping that it actually does for your business at PagerDuty?
Well, what we're really hoping is that it just continues to improve the experience that our customers enjoy when they're working with our products. So SRE agents are people that are today helping to keep the software estate running around the world. The SRE agents that we deploy leverage all the telemetry that we can see from our thousands and thousands of customers to help build an even better solution that's automated in its execution, that ensures that when there are problems, they're fixed even faster, that they're fixed more accurately, and that you have great telemetry on exactly what happened, so you make sure you don't do it again. That ultimately lets our customers have much more resilient infrastructures and keeps this AI economy running.
And Jennifer, under your leadership, we saw such a high percentage of the Fortune 500 put their trust into PagerDuty. Why was that the case, and what is the feedback like from a lot of those massive firms?
I mean, at the end of the day, two-thirds of the Fortune 100, nearly half of the Fortune 500 choose PagerDuty because we are the only enterprise-grade platform that's demonstrated through our track record that no matter what's going on in the market, public services failing, cyber attacks, et cetera, that we are there to support our customers in their most important and sometimes most difficult day. And we're in a great place from a platform perspective with AI features throughout the platform, with a very strong customer base, a terrific team, and it made this the right time to hand the baton. But the thing that also made it a brilliant opportunity is that John is the right next leader, and I'm just thrilled to partner with him, and the board and I are so proud to have him here today and introduce him to everybody here on the trading floor.
So John, one more on the technicals and a big order of business. You recently announced a $100 million share buyback. Talk to me first and foremost, what does that say about your confidence in where the firm is, and where do you see PagerDuty headed next?
Well, I think that announcement that we made last quarter really speaks for itself. We feel very confident and feel confident about our ability to generate the cash that we would need to execute on something like that. I think where we're going next is just helping those customers that we've already had so much success with. We have, as Jen alluded to, two-thirds of the Fortune 100 we call customers. That's where we plan to continue to invest. A lot of them are listed here on this exchange, and we're just excited to be part of keeping their businesses running and allowing them to not only benefit from digitization, as I mentioned, but also from AI, and being able to focus on growing their businesses, making their businesses more profitable. That's what we exist for. That's what we've done so well for the last 10 years under Jen's leadership.
You've had incredible growth, incredible momentum. I'm really grateful for the time for both of you. After ringing the closing bell to stick around a few extra minutes for the broadcast. John, congratulations on the new role. Jen, welcome back to the exchange, and thank you both.
Thank you, JD.
Thank you for having us.
Absolutely. Don't go away. A lot more taking stock coming up right after this. Stand by. Welcome back to the show. Time for a few headlines in the world of fintech, crypto, and artificial intelligence you need for your Wednesday afternoon. At this hour, the crypto majors are in negative territory, but fractionally. Next up, AMD agreeing to sell Anthropic tens of billions of dollars worth of AI servers and make a significant investment up to $5 billion in the startup. Finally, the Bank for International Settlements warning that the U.S. dollar-backed stablecoins can bypass capital controls, raising significant concerns that they could weaken the ability of governments to regulate cross-border money flows. And now Money 2020's very own Scarlett Sieber is back with a new edition of Jargon Translator. That's where she puts complicated finance terminology into language that anyone can understand. Take a look.
I'm Scarlett Sieber from Money 2020, and this is Jargon Translator. Today's term is narrative risk. Narrative risk is what happens when the story supporting a business or market changes, even if the numbers haven't changed yet. Markets don't run purely on spreadsheets. They run on explanations. Why does the company deserve capital? Why does the sector matter? Why does this time feel different? A narrative holds those answers together. Narrative risk appears when the story gets questioned, the explanation, it just kind of stops working, or a better story replaces it. Importantly, narrative risk doesn't show up on income statements. It shows up in, you guessed it, behavior. Capital hesitates, multiples compress, management suddenly has to explain a bit more. Think about past cycles as another example. So dot-com stocks didn't collapse because the internet wasn't real. They collapsed because the story that growth alone was enough, that stopped convincing people. Fast forward to today. AI, fintech, crypto, the technology may be real, but narrative risk lives in the expectations. When timelines stretch or outcomes feel less certain, the story gets repriced. Narrative risk doesn't mean something is wrong. It means belief is being renegotiated. And markets always renegotiate belief before they change those numbers. So that is your Jargon Translated. If there's a term that you want decoded before the story shifts again, drop it below and it might just make that cut. In the meantime, back over to you.
Welcome back to the show. Tomorrow morning here on Wall Street, we are expected to get the latest quarterly results from a handful of key names we'll track for you very closely. We'll hear from the latest from American Airlines, Blackstone, Lockheed Martin, as well as Dow component Honeywell. And this time tomorrow after the bell, the latest quarterly results from Intel as well as Deckers. Your final tail of the tape on this Wednesday, July 22nd from the New York Stock Exchange. The S&P 500 down fractionally. The Dow in negative territory, 0.01%, so close to a positive gain. The New York Stock Exchange Composite Index in the green, 0.1%, and the small caps down 0.9. Thanks for watching this edition of Taking Stock. Have a great Thursday night. We'll see you again tomorrow.